Having seen all the videos out there on income statements, I can confidently say this is going to be the best video on how to understand and master an income statement. If you want to get into investment banking or get anywhere in finance, the most important skill that you need to learn is the language of business. And the language of business is accounting, or in this case, how to read financial statements. Now, don't worry, you don't need to be an accountant to be able to understand an income statement. Trust me, investment bankers are not accountants, but we can still dissect and understand an income statement. In this video, I'm going to show you exactly what goes in an income statement, what to look for, the problems with income statements, like why do interest go on an income statement but not the debt? Then we're also going to take a look at real life examples. We're going to take a look at income statements from Netflix, Amazon, Starbucks, even Tesla. So a lot to get through, so let's get started. Now, number one. The income statement shows the total revenue a company has generated with the associated costs all the way down to net income for a period of time. The income statement is also known as the statement of profit and loss, or P&L for short. Now, before we take a look at real life examples, I really want to show you what a typical income statement looks like in detail. So after this video, you'll be able to confidently look at any income statement and be able to understand exactly what it says, because we're now going to take a look at an income statement line by line. So what you see right here in front of you is the three financial statements: the income statement, the balance sheet, and the cash flow statement. Now, I have a video on each of these financial statements, but right now we're going to be focusing just on the income statement. Now, this Excel model which you see right in front of you right here is actually from the Ultimate Investment Banking Interview Guide and Financial Modeling course. Now, this is used to practice for the investment banking technical interview section. So for example, common questions which you would tend to get is what happens when depreciation goes up. So in this case, you'll be able to see exactly how this is going to be reflected on each of the financial statement, step by step. So for now, we're just going to be looking at what is on a typical income statement. So like I mentioned, the income statement is prepared for a period of time. Now that could be for a month, a week, a year. When we are looking at these numbers represent what has been achieved, what are the revenues for a year, what are the costs for a year. So revenue, it's the first line item which you're going to see on an income statement. Now, revenue is pretty much simple. It's just everything which the company has sold for the period of time. You then have cost of goods sold. Now, this can also sometimes be known as cost of sales or cost of goods sold, but the issue with this is it's the direct cost. Cost of sales or cost of goods sold is the direct cost. So if you're Apple and you sell iPhones, the direct cost of producing each of your iPhones would be the cost of the chips, the screens. So the cost doesn't go down with additional increases. It's constant. And that's the direct cost which you're going to see first. So revenue minus cost of goods sold gives you gross profit. So after we've taken a look at the direct cost, we're now going to take a look at indirect costs. And indirect costs are normally listed as general and administrative expense. Now, this typically encapsulates your cost of marketing, your cost of research and development, your administrative expense. If you're a pharmaceutical company, for example, you are going to be spending a lot on research and development, developing new formulas, new patents, new drugs which you're going to sell on the market. So you are likely going to have a separate line just for your research and development. But if you're not a pharmaceutical company or you don't spend a lot on research and development or R&D, then you tend to encapsulate all of those in just general and administrative expense. So that's what general and administrative expense relates to. It's your indirect expense. So now we're going to take a look at your non-cash expense. Now this is very interesting and it's one of the problems with an income statement, because your non-cash expense are expenses which you haven't actually paid for. It's just the way that accountants capture expenses. Now let's just take a look at a couple of examples. Depreciation is a very common example, and depreciation essentially relates to the loss of value on physical assets. For example, let's just say you have a factory, a brand new factory which you've just bought at the start of the year. You have all your new machinery or your new equipment, but let's just say you've been using this for a whole year. Now at the end of that year, that factory is no longer brand new. You've used it, it has wear and tear, it's lost value. It's no longer as valuable as it was at the start of the year. Now that loss of value is encapsulated in depreciation. Then we have stock-based compensation. And this is essentially, instead of paying your staff, your employees' salary, cash, you pay them with the company's shares. So you haven't paid them with cash, you just paid them with the company's shares. So again, it's a non-cash expense. Then amortization of intangible. Now, similar to depreciation, except this relates to intangibles. Again, companies like pharmaceutical companies, which have a lot of intellectual property, or other type of companies which have intellectual property or brand names, reputation, these things can take a hit and they lose value over time. So just like you'll capture the loss of economic value on your tangible assets, on your factory and machinery in depreciation, you also have to capture the loss of economic value on your intangible assets. And that's recorded under amortization of intangibles. So now that you have your gross profit, and then you take away your indirect expense, so your SG&A, and then your non-cash expense, you are then left with operating income, which is EBIT. So EBIT stands for earnings before interest and tax. So now that we have this, we can now take a look at our interest income and interest expense. Now, the reason why interest goes on the income statement is because it is tax deductible. The reason why your non-cash expense goes on the income statement is because they are tax deductible. So you're probably thinking, there's a lot of tax deductibility on the income statement. And you're right, one of the main reasons why the income statement exists is to judge how much tax you have to pay. So anything which affects your tax position, your taxable amount which you have to pay at the end of the year, goes on the income statement. Whatever doesn't affect your tax will not affect your income statement. So why am I bringing this up? Interest will affect your taxes because interest is tax deductible. The more you have to pay in interest, it reduces your taxes. But the debt doesn't affect your taxes, so the debt goes on the balance sheet. Now take a look at our video on the balance sheet to have a better understanding of this, but essentially, because the debt doesn't affect your tax, it doesn't go on the income statement. Only the interest part goes on the income statement. So, interest income will increase the amount of taxes which you have to pay because it's income, it's taxable income. Interest expense reduces the amount of tax which you have to pay because it's an expense. Goodwill impairment. Now, goodwill impairment is another type of cost that pretty much arises when one company buys another company. But when you buy another company, the value which you've paid for that company, whatever is above book value is essentially assets minus liabilities. Whatever is above that is goodwill. And this is pretty much how investment bankers record this. And sometimes that goodwill will lose value over time, or you might have miscalculated it, or the company might have taken reputational damage, or something might have happened with this company which has caused it to lose value, and you record that under a goodwill impairment. PP&E write-down. Now, PP&E stands for plant, property, and equipment. So your physical assets, your plant, your machinery, your land, whatever you might have, whatever economic resources which you have, pretty much these are large items, and sometimes they might lose value. And if it has lost value, then you have to record the loss of value here. And again, these two things, there are others, but these are quite common. Because they affect your tax situation, it goes on the income statement. So once you have your operating income, you then take away your interest income and expense and other type of expenses which affect your tax position. You're then left with your pre-tax income. So depending on depending in which jurisdiction you're in, depending on the country you're in, different country will have different tax rules. You will then make a provision for your taxes, so how much tax would you have to pay. Now, deferred tax provision. Now, this is something which we have here for the purpose of practicing for the for interviews. But essentially, deferred taxes, it's something that occurs when you have either overpaid or underpaid your taxes in a previous year, and that difference will then affect the next year. So don't worry too much about this. This is something that you have to practice for your investment banking interviews. That's why it's here. So once you have your pre-tax income, you then pay your taxes. What you are left with is your net income. Now, this is the cash, this is the profit which you've made for the year. Now, that's typically usually it. Now, for the purpose of companies which have shares, you then have to calculate the EPS, which stands for earnings per share. Now, earnings per share is a very simple calculation. It's simply your net income divided by how many shares which is outstanding. And essentially, it's a gauge. It gives investors an understanding of how much earnings which they can get per share. Now, you have a basic earnings per share, you then have diluted earnings per share. The difference is diluted earnings per share also includes the effects of options expiring to profitability. So it increases the amount of shares outstanding. So your diluted earnings per share will be a lot lower than your basic earnings per share, but that's something which we're going to take a look at when we take a look at real life examples. So this is pretty much what an income statement looks like. These are the main line items which you're going to find on an income statement. So before we take a look at real examples, I just want to let you know that this Excel model which you see right here in front of you is exactly the one which you're going to get in the Ultimate Investment Banking Interview Guide and Financial Modeling course for you to practice the technical questions which you will get during your investment banking interviews. Again, for example, if depreciation or any of these things which are commonly asked during your investment banking interviews, say for example, if depreciation goes up by 100, you can easily see how this will affect everything, every line item on each of the financial statements. It makes it a lot easier to understand as opposed to just memorizing the answer. Our guides and courses have been used by thousands of candidates to land multiple interviews and job offers in investment banking, from Morgan Stanley to Credit Suisse, all the major bulge bracket banks and even middle market banks. So if you are interested in breaking into investment banking and want to check out the kind of interview questions which you need to prepare for, then do check out our video, which I'll put a link in the description below, where I'll cover all the category of questions which you need to prepare for to ace your interview. I'll also put a link where you can get these interview guides as well. So now let's take a look at a few examples, starting with Amazon. So right here is Amazon's income statement. Now, this is pretty much from their annual report, which you can Google. The numbers which you see on your right-hand side are the years, 2017, 2018, 2019. It doesn't really matter about the years. The point is, what we're more interested in is how they've laid out their income statement. So on the left-hand side are the line items. And as we have pretty much already covered, the first line item is going to be their revenue, so net sales. Now, because Amazon is pretty complicated, they have physical products and services, they've separated it where you have product sales and service sales, but essentially net sales. You then have operating expenses, again, cost of sales, the direct cost. You then have your non-direct costs, so general and administrative expenses, other expensive, so total operating expense, and then your operating income, which is again your EBIT. So nothing really stands out. The one thing which does stand out is that EBIT has dramatically gone up from 2017 to 2018, which should have a dramatic effect on their share price. And then after that, you have your interest effects, and then other income and expense, which I've shown you on the Excel model. So then after that, you have your total operating income. And then you have income before income taxes, provision for income taxes, and then net income. And after that, you have your basic earnings per share. and your diluted earnings per share. Now remember what I said, that the diluted earnings per share also include the effects of options affecting your shares outstanding, so it should be lower than your basic. So the basic EPS is $23.46 and the diluted is $23.00. So that's Amazon. Let's take a look at Starbucks. Now Starbucks it's not the best graphical income statement. Essentially they generate income from various activities. So their total revenue line item is right here. Then you have their cost of sales, store operating expenditure. Now every company is going to be different, so they are of course going to want to separate or draw attention to specific line items or to specific costs which is subject or which is significant to them or to their operation. Depreciation and amortization, general administrative. Now here you can see restructuring and impairment. This is a significant line item for them. Not something that we've covered, but essentially it is, again, it's part of the expenses. You then have total operating expense and operating income, EBIT. You then adjust for interest expense. You then have your net earnings, and then you have your EPS. Now, Tesla, again. Now, what's interesting with Tesla is that they have, under operating expenses, they have research and development. This line item has been highlighted right here because for them R&D is significant. But essentially everything else is pretty much the same. Apple's income statement is very clean, very easy to follow. So again, pretty much everything which they have here we've already covered. So that's pretty much the income statement. Some of the other things which are important on the income statement are metrics like EBIT and EBITDA calculations. These are very common and used to compare companies within the same industry within investment banking. Now, the EBITDA number is the starting point to calculating your free cash flow in DCF model. Again, something that we're going to cover in another video. Another important comparable number is the PE ratio. Again, I'll make some more videos on this later on, but again, just to draw attention to this. So that's pretty much on the income statement. Do check out our video on the cash flow statement and the balance sheet after this. I'll see you in the next video.